Welcome back to Investing Talk Podcast.
Today we're looking at Li Auto. The big question is it a good time to buy now?
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. For you, the investor, the current Li Auto story presents, well, it's kind of a paradox, really. You've got a spectacular revenue growth, right? Driven by successful product launches.
Absolutely. Impressive top line.
But then that's offset by some really aggressive strategic spending that's hitting immediate profitability quite hard.
Right.
So we need to figure out, is this visionary growth or maybe just an expensive race to the bottom?
Yeah, I think that framework, visionary versus race to the bottom, that sums it up perfectly. Let's start with the upside, the momentum they've got right now. When we talk Li Auto, we're talking about a company that's really carved out a dominant spot, a premium position in China's new energy vehicle market, the NEV market.
Exactly. They aren't just chasing volume at the low end. No, they're selling these, pricier family SUVs.
Premium play.
And that leadership, it's not just talk, it's quantifiable. Their cumulative deliveries, as of the end of October 2025, it stands at 1,462,788 units.
Wow. Almost 1.5 million?
Think about that scale. That really establishes a significant moat,
Yeah.
And consumer acceptance in what is a brutally competitive market over there.
But the proof, like the current health proof, is in the immediate numbers. In October was strong.
Very strong.
They delivered 31,767 vehicles in just that 1 month.
Mm-hmm.
That tells you the market acceptance isn't just like old news or legacy buyers. It's firm. It's accelerating even. And that's the immediate signal we look for when trying to gauge, how the quarter might shape up.
Yeah. And that recent delivery strength, it's completely tied to their product strategy. Very deliberate diversification.
Yeah.
They successfully targeted that high-end family segment, and now they're expanding within that niche.
Exactly. The new light i8 SUV introduction is a huge part of it.
All right, the BEV.
Deliveries for that 6-seat battery electric SUV, they started back in August 2025. So by adding the i8, they didn't just launch another car, they really broadened their appeal within that high-margin family segment. It signals they're serious about offering more variety beyond just their core L-series.
Which, for an investor, it mitigates that single product risk they may be faced before.
Definitely.
And, successful car sales, they rely on solid infrastructure. You can't keep that premium brand image if your customers are complaining about service or finding a charge.
True. Big problem for EVs sometimes.
So to tackle this, Li Auto has done a massive scale up. They now boast 535 retail stores.
535.
And they've installed 3,028 supercharging stations across China.
Okay, over 3,000 chargers. That infrastructure investment, it feels like a huge defensive move.
It is.
It really solidifies their moat against local competitors, and it directly tackles that critical pain point for NEV adoption, range anxiety after sales support. They're spending money now, seems like, to lock in that long-term customer loyalty.
Which brings us right back to the financial health discussion. And this is where we see that split you mentioned earlier. The aggressive spending on infrastructure, product rollout, marketing. It's all great for the top line, for revenue.
Yeah, boost sales.
But it comes at a pretty steep price for immediate profit.
Okay, let's start with the good side then. The undeniable positive. Their 2024 revenue growth looked, robust.
It was. CNY, $144.46 billion. That's roughly USD $20.01 billion.
And up 16.64% year over year. That's impressive.
It shows consumers are absolutely buying the product, right? They are selling cars successfully. No question there.
But then, the challenge is what happens after the sale. The cautionary note. The thing the market seems skeptical about, that drop in net income.
Exactly. Net profit in 2024, it fell 31.37% year over year, dropped to CNY 8.03 billion, or about USD 1.13 billion.
Oof, 31%. That's not a small drop, is it? Even in a growth market? So does this mean they're just resorting to unsustainable price cuts, just trying to move metal?
Not entirely, no.
Yeah.
We have to add some context here. The sources suggest this was actually a conscious strategic choice. The profit squeeze was driven by two main things. One, those massive strategic investments we talked about.
R&D, the i8, the chargers.
Exactly. And two, the unavoidable competitive pricing pressures in the Chinese market. It's fierce. They're essentially, buying market share. And that is an expensive game of chicken to play.
Okay, buying market share. But how stable is the profit that's left? The sources mention a net margin of around 5.6%. Now, for a company growing this fast, Is that genuinely healthy? Or is that kind of razor thin, highly vulnerable if, say, battery costs tick up or another price war breaks out?
That is absolutely the right question. And yeah, 5.6% is narrow. But the key insight here, I think, is that their balance sheet provides a massive safety net.
Okay. How so?
Well, they operate with low net debt,
Mm-hmm.
and they have ample liquidity, plenty of cash.
Right.
This financial firepower lets them keep making these expensive strategic moves without facing, like, immediate solvency issues or debt problems. In short, they can probably afford to run at a lower margin for a bit while they finish this big build-out phase.
Got it. So the foundation's solid, but the margins are the immediate worry. If that's the pain point, what are the dates? What are the events coming up that could really move the needle here, generate some quick share price action?
Yeah, the next few weeks look absolutely packed with potential volatility.
Okay.
The immediate high-impact event is the Q4 2025 earnings release that schedules for November 28th.
November 28th. Mark the calendar.
This is the moment, really. They either confirm the market skepticism or potentially prove the bullish case.
And we know their previous guidance wasn't great, right? It was seen as underwhelming. That definitely contributed to the stock pulling back recently.
Correct.
But, and this seems critical, those strong October delivery numbers we just discussed, they were reported after that guidance came out.
Good point.
So if those strong deliveries also came with, say, stabilized cost controls, and if the average selling price for those premium models held up okay, we could see a positive surprise.
Which could instantly re-rate the shares higher. Exactly.
Yeah. Okay, that's the big one. Anything else?
Well, beyond the company itself, there are some institutional catalysts potentially at play. These often create sort of structural buying pressure.
Like what?
We're talking about ETF portfolio rebalancing. That happens throughout November.
Oh, right. Index runs.
Yeah. For you, the listener, this means large fund managers are often forced to buy or sell huge blocks of shares sometimes, regardless of their own opinion on the price, just to match index weightings.
So if Li Auto is being added to key ETFs or its weighting increased, that provides a kind of structural tailwind.
Precisely. It's sort of invisible pressure, but it can move a stock significantly.
Interesting. And looking a bit further out, product news?
Yes, the product pipeline. That's always the engine for excitement, isn't it?
Usually is for these growth stocks.
Management has been strongly signaling an upcoming unveiling. New SUV models, updated hybrid variants, expected sometime in December 2025.
Okay, so earnings end of November, new product news potentially in December. That sets up a potentially positive narrative heading into next year.
It could, yes.
Yeah.
Now let's ground this a bit in the technical picture. We've seen a significant pullback, no doubt.
Yeah, it's come off its highs.
The stock's currently trading between, $20.49 and $21.34, somewhere in there.
Right. Which is quite a bit off its 52-week high of $33.12.
Substantially off.
Hmm.
But importantly, it has managed to hold above the annual low of $19.10.
So that $19-20 range seems to be acting as a pretty strong floor, psychologically and technically?
It appears so. And the technical setup kind of confirms this current hesitation in the market. While the stock is technically trading below both its 50 and 200-day moving averages, that's a classic bearish signal.
Yeah.
The RSI, the Relative Strength Index, is stabilizing around 59.
Okay, 59 isn't deeply oversold, but it's not overheated either.
Exactly. It suggests the really aggressive selling has cooled off, and maybe some accumulation is happening at these lower prices.
Investors picking up shares, betting on that earnings surprise we talked about?
That seems likely. Picking up shares, yes.
And what about the Wall Street analysts? What's the professional consensus?
Officially, the consensus is a hold.
Okay. Cautious.
But that hold is based on a, let's say, conservative average price target of $24.50.
$24.50. That implies about, what, 15% upside from where we are now?
Roughly, yes. And crucially, some of the more bullish analyst targets, they stretch up towards $28.
Okay, so even the cautious ones see some upside, and the bulls see quite a bit more.
Right. The street is cautious, but they definitely acknowledge there's a significant potential tactical opportunity here if those upcoming earnings give the green light.
Okay, speaking of caution, we have to cover the risks. And they seem pretty substantial, too.
They are. You can't ignore them.
We mentioned the continuous margin pressure, right? Intense competition, promotional activity in China.
That's ongoing.
Then there's inherent execution risk. They're rolling out models aggressively, scaling infrastructure.
Right.
Things can go wrong.
Always a risk with rapid expansion.
And, of course, the ever-present supply chain risks, semiconductors, batteries. Bottlenecks there can really hurt production.
Those are fundamental risks. They have to be managed day to day.
But there's also this highly speculative element, isn't there? The short squeeze potential.
Yes. That
Yeah.
links directly back to that margin risk we discussed.
Short interest has climbed recently. It's now at 23.34%. That's high.
Very high. That implies a huge chunk of the available shares, the float, is being bet against the company.
So does the market believe that margin drop is permanent? Or are they just betting against the upcoming guidance, thinking Li Auto can't show cost control?
It's probably a mix of both.
Yeah.
They see the underlying structural weakness from competition,
Right.
and they're betting that the Q4 guidance will confirm that the margin erosion is systemic, not just a temporary blip from investment.
Yeah.
But that high short interest, it adds enormous speculative fuel. If those November 28th earnings come in positive, if they demonstrate margin stabilization,
Then the shorts have to cover.
that level of short interest could trigger a very sharp rally, yes, as those bears scramble to buy back shares and cut their losses.
Wow. That makes the next few weeks feel like a really high leverage trade potentially.
It certainly adds a layer of potential fireworks.
And we can't ignore the usual unconfirmed chatter, right? The rumors that always seem to swirl around these stocks, driving sentiment, even if they're just speculative.
Always part of the game.
We're hearing whispers about potential international expansion, maybe Southeast Asia or even Europe.
Yes, that's out there. And also some chatter about technology moves, potential new battery tech partnerships,
Yeah.
maybe upgrades to their AI platforms.
Just like that.
Yeah. Now, these are currently just whispers, right? Unconfirmed.
Need that grain of salt.
Absolutely.
Yeah.
But a single press release confirming any of these major moves, that could easily be the catalyst to push the stock back towards those higher analyst targets, maybe that $28 level.
Okay, so let's try and wrap this up. Bring it together into an investment horizon summary for the listener. Where does this leave us?
All right. Given the strong market position they've built, that resilient balance sheet, even with all the investment spending and the technical stabilization we're seeing,
Yeah.
the overall thesis, I think, remains highly bullish for the long term. We'd rate it maybe an 8.5 out of 10 for patient long-term holders.
8.5 out of 10 long term.
Okay. Li Auto clearly has a moat. They have leadership in that premium family segment. That's valuable.
But you mentioned the tactical opportunity earlier, the short term.
Yes, because right now the stock looks uniquely attractive for short-term trading,
Yeah.
purely because of those imminent high-impact catalysts.
Then off 28 earnings, the December product launch.
Exactly. These are clear potential inflection points. They offer, asymmetric returns if the news breaks positively, bigger upside potential than downside risk, perhaps, in the very near term.
Okay, so it's really clear the immediate story, the narrative for Li Auto, it hinges entirely on them proving those big investments are manageable. That the margins aren't just collapsing. You absolutely have to monitor that November 28th earnings report. Thanks for joining us as we explored Li Auto's potential today.
This entire thesis hinges on the company demonstrating cost control stability and stabilizing margins in that Q4 guidance, making margin trends the single most critical factor to watch in the coming weeks.